Been in this business about 44 years. There's a few in the room that have been in this business a lot longer than that. And over the past 2 or 3 years or 4 years, we've had Dodd-Frank, Jobs Act. We've had a number of rules, regulations, and there's too many conferences and places I've gone that left with a depression factor that is just unreal. So thinking about that and how to do business again, in fact, I've been involved in the 25-102N, which is a California offering with a company. There are ways to go. I think we need to get off the regulatory depression, if you would, and impediment, and let's move around and see what we can do now and today. And my panel today are people who have been there and done it and experts in the field. There's a lot of misconception about Reg A and what we can do right now. And for presenting companies, this is also a really difficult situation of raising money. Solicitation, non-solicitation, or whatever. But I think there are things today that we can do, not only on the broker-dealer side, but also on the presenting company side. And we're going to try to make this interactive. We'd like you to leave this room with answering your questions, number one. Number two is to give you some of the real versus the perception of things that have gone around and happened. So with that, I'd like to introduce my panel, if I may. Not in any given order, Mr. Paul Getty. He's based in Silicon Valley. Paul co-founded First Guardian Group in 2003, a real estate investment and management firm focusing on the development, selection, and management of over $800 million of commercial real estate offerings, placed exclusively through broker-dealers. Prior to forming FGG, Paul was an active venture capitalist with technology investment firms, Venture Navigation, and Seawick Ventures. His prior operating experience spans over 25 years as a serial entrepreneur and executive officer in firms that resulted in investor returns of over $700 million through multiple successful IPOs and M&As. Mr. Getty is a licensed real estate broker, holds an MBA in finance from the University of Michigan, graduating with honors and a bachelor's degree in chemistry. So please welcome Mr. Paul Getty. In the room? Thank you. Sure, he'll be coming in a moment. And our next on the panel is Mr. Robert Kaplan. Robert and I crossed paths several years back, and he kept saying to me something called Reg A, and I kept dismissing it. That's impossible. That died before I was registered and licensed. Rob is currently managing partner of Kaplan, Volker, Cunningham, and Frank, based in Richmond, Virginia. Rob is being referred to as the guru of Reg A, due to his involvement and influence in bringing about new changes that will have a dramatic impact in rekindling investor interest in alternative investments. He is a leading speaker on Regulation A and the syndicated TV shows. Rob has represented clients as diverse as Fortune 100 companies to startups. Over his career, Rob has been counsel in securities offerings, transactions, and syndications worth over $2 billion. Rob holds a JD from Marshall White School of Law, College of William & Mary, and AB from College of William & Mary. Please welcome up Mr. Rob Kaplan. Thank you. And finally, Mr. John Merriman, old colleague from San Francisco days in the 80s. John is a co-founder and CEO of Merriman Holdings, Inc. Based in San Francisco. John led the growth of the firm from 6 people and $1 million in revenues to over 200 employees and $90 million in revenues in 2007. John has served on more than 10 private and public company boards, actively advises the firm's fast-growing public companies on complex capital market and financing issues, and also works with small-cap, growth-oriented investors. His extensive institutional and personal net worth and his trading experience give him a unique perspective when working with investment banking clients as well as institutional investors. John has been a frequent guest on Bloomberg TV, as well as CNBC show Fast Money, and a regular contributor to financial publications such as the Wall Street Journal, Barron's, and Daily Deal. John holds a BA from Dartmouth College and is based in the firm's San Francisco office. So again, panel, welcome. As you can see, we've got the best of the best here, so we're going to get fired. Would you like to open just a little comment and then go into the Q&A?
Well, yeah. First of all, thanks everybody for attending. Paul Getty. I like to make a little plug as we get started for our booth, which is around the theme of Reg A. It's called Reg A Exchange, and it's not a trading exchange, it's an information exchange. And we encourage all here that are attending that have an interest in the subject matter that we're going to be covering to stop over and either give us your business card to register later or register at the booth so that you can participate in it. The information portal is designed primarily to have broker-dealers communicate with other financial professionals to get their questions answered, and also to present case studies and other relevant information as further, hopefully, positive developments take place. So thank you.
Thank you. And please, I think, we're trying here, all working together to raise capital and raise capital formation. So we're going to start off, and please, if you raise your hand, you got some questions. There's a few here that we've kind of put together. I was talking to a number of you. We'll start off, and I'll go from the brokers and advisors to the companies also, so we'll alternate. The first question, when will the SEC issue additional guidelines on Regulation A? Who wants to take that one? Rob?
I guess I'll take that.
Mike?
The Regulation A changes that we're expecting to see shortly from the SEC were mandated under the Jobs Act, which was a compendium of a number of pieces of capital formation reform legislation, which included Reg A, aspects of 33 Act registration, crowdfunding, and public solicitation under Rule 506 of Reg D. Interestingly enough, while they did put some time limitations on the SEC for the IPO on-ramp, the 33 Act registration requirements, as well as 506 general solicitation, they did not do that with Regulation A. And I think it's a distinction without a difference, because as we all know, the SEC kind of blew through those time requirements that were put on them, as they have done historically with a number of pieces of legislation. What we know is that the Office of Small Business Policy at SEC had as a goal to try to have some proposed regulations out this fall. We haven't seen them yet, and they could come at any time, but the conventional wisdom, in my personal opinion, is we probably will not see anything until post-election at the earliest. I think many of the commissioners and senior management at the SEC want to see what party will be in control after the elections. For some of them, it will determine whether they have a job or not, and then they'll start moving on some pieces of regulation that they have to get out to the public, including Reg A. The Office of Small Business Policy is very focused on this right now. They understand that this is pretty critical to the lower mid-market and mid-market in this country. And we're hoping to see final regs sometime in the first quarter or early part of second quarter of 2013.
Thank you. And remember, again, it's a ways over, and we're trying to suggest to you that we do not have to wait longer. Time is not in our favor. We need to get out and start raising capital today. From one of the companies, one of the questions came in, what are the main benefits of Reg A versus an IPO? What are the main benefits? Who wants to take that one? John?
Monopolize it.
Don't
I
get
think it's
bashful.
pretty straightforward. The benefits are time period to issuance, cost and disclosure. There's also the advantage of being able to mount a general solicitation prior to the deal, so broadening the potential universe of investors. So the intent, if it gets executed appropriately, is to expose more companies, good small companies, to the capital markets. As some of these slides show, that the capital markets have been largely shut to high quality but small companies over the past couple of years. I think the numbers, Paul, were 82 IPOs of sub-$100 million market cap companies in 2005, 16 companies in 2012, small sub-$100 million market cap IPOs. So the market's been shut. There's plenty of capital interested, and hopefully Reg A will bring some of that capital back into the market. But you're the expert. What else?
Well, I think what is important to remember is that Regulation A, unlike Regulation D, is not premised upon the character of the offering. It is literally a regulatory regime that, if it is complied with by the issuer, the SEC exempts you, or the securities being issued by the issuer exempts them entirely from the 33 Act registration regime. So in effect, what happens is you have a public security that you don't have to follow 33 Act public registration. The SEC will make sure and will continue to make sure, as in every context, that the anti-fraud regulations and rules are being complied with. But once you are qualified as exempt under Regulation A, SEC is no longer involved in the process of regulating that offering. That means accredited investor requirements that you see typically under Regulation D are not required. You have to comply with state suitability requirements, which are much lower. There is the public solicitation that John spoke about. And so you can reach a broader market. And then finally, there is liquidity. Regulation A allows free tradability of these securities. The Jobs Act reiterated that concept again. And so what's very important here is the opportunity now going to 50 million to create, in my opinion, an intermediate public securities market here in the United States. Because of the amount of regulation that 33 Act registered companies have, you know, just from the SEC, from Dodd-Frank, from Sarbanes-Oxley, you've found a situation in this country where you could really only talk about $1 billion plus IPOs being feasible. Now you have a regime where reduced cost, regulatory, legal formation make it an opportunity for the lower mid-market, the mid-market, to really look to create a viable trading market again in public securities and with reduced cost and speed to market.
Question in the back, Carl.
You make it sound like there's no submission to the SEC, which is nuts.
Actually, that's not what I said at all. I said if you comply with the regulatory regime that SEC has in place.
What you're saying is, don't worry about it. It's a public offering, albeit exempt. You have to go through a submission process at both the federal and state level.
That's absolutely true. There's a review and comment process at the federal and the state level. It is significantly less burdensome than 33 Act registration. It provides for an oversight process. It requires transparency, which allows this to be, at a $50 million level, a credible public market for securities.
Bill?
What is the significant difference in terms of disclosures? You're talking about a 33 Act versus, the Reg A Act.
Sure. Under a 33 Act registration, you have to comply with Regulation SK for the pros disclosure, and you also have to comply with Regulation SX for the financial disclosure. And these are very complex, very thick sets of rules. If anybody in this room has been involved with the process of doing an IPO and 33 Act registration IPO, you know that the estimate of legal fees, depending on the size of the law firm you're dealing with and the size of the deal, could range anywhere from $500,000 to over $1 million just for the legal. And then you talk about the accounting and the Sarbanes-Oxley compliance and so far and so forth. Here, under Regulation A, you have to comply with the instructions that go along with Form 1A, and you have to comply with what's called Part FS, which is a much more streamlined method of disclosure. It follows the same sort of logic and conceptual regime as a prospectus, but it's in a much more streamlined form. To give you an example, under current regulations, not the regulations that would be promulgated under the Jobs Act, under your financial disclosure, you don't have to provide audited financials at the federal level. Most states require it, but they only require at the federal level GAAP compliant financials. So, what it's been designed to do is essentially within the context of the same logic. And by the way, Regulation A has been in existence since 1938 in one form or another. It's sort of created a minor leagues of public registration process, if you will. They've merely taken into mind the types of companies, the size of companies that might be taking advantage of this kind of financing, and they've tried to downsize the regulatory burden associated with it to fit the needs of those companies. So it's just really kind of a scaled down version of the prospectus.
Once you've got the deal, let's say you've got the deal priced and commenced trading, I mean, they're still obligated to file their audited financials every quarter as well, review quarterly and annual financials audited every year anyway, aren't they?
Under the existing regs, there's no ongoing reporting requirements. Under the new regulations, the Congress has mandated in the Jobs Act that annual audited financials be filed with the SEC. And we expect there to be some sort of quarterly reporting status filed with the SEC, but you're not subject to Dodd-Frank, you're not subject to Sarbanes-Oxley. It's, at least what I've been told, is they're looking to have a very streamlined, regular reporting process with the goal of trying to create some transparency for markets, but keeping in mind the legislative intent of not overburdening.
Like Sarbanes-Oxley compliance?
Right. The Sarbanes-Oxley does not apply to Regulation A.
Where's the line where the crossover is, where they're gonna be stuck with the Sarbanes-Oxley?
That's 33 Act regulation.
But where's the line you cross over to where you're gonna be subject and burden of that? Let's say you've done a Reg A deal, and you raised $20, $30 million, you got it out, you file on your end, your quarterly reports. When's the crossover to where you're getting stuck with everything?
If you're forced to register as a 33 Act public company, then you have those requirements.
What forces that?
That could happen primarily through one of two channels. One, you decide that it's now time to move to a larger public market, or you have whatever strategic basis for going ahead and registering as a 33 Act registered company. Or you would trigger the reporting requirements under the 34 Act, what they call the 12G rule. So once you have, under the new legislation of the Jobs Act, once you have $10 million in assets and 2,000 investors, it used to be 500, it's 2,000 investors under the Jobs Act, 500 of which can be non-accredited in a given class of equity securities, you have to register as a 34 Act reporting company. At that time, you would have to do your public registrations, and you'd be subject to Sarbanes-Oxley, Dodd-Frank.
Michael, you had a question?
Yeah, I wanted to ask if you would make a comment on the current interactive relation between the issuer and the various states today versus where you think or hope it will be when they come out with the
Sure. Right now, Regulation A is not a NSMIA-covered security, so it is subject to state securities law review. So when I typically do a Reg A offering right now, we're not looking to register at $5 million. We're not looking to register in 20 states or 30 states. We usually register in 3 to 5 states at a given time, and it usually has a geographic focus or some strategic basis to it, where you think your investors are going to come from. Some states have filing by coordination or registration by coordination, meaning that you are cleared to sell in that state as long as the SEC has signed off on your offering circular. They reserve the right to review the offering and intercede if they think that there is some issues related to their state securities laws. Others do require qualification by full registration. You have to go through a parallel process with the state at the same time you're working with the SEC. Right now, our experience has been, and I want to emphasize this, this has been our experience because there's nothing in the law that states this. But our experience has been that these state securities regulators, you got to feel for them, they're being buried by the number of registered non-traded insurance products, annuity products, now Regulation A, that they're having to review at any given time. Their budgets are constrained, and they're not getting any more money from their states anytime soon. So what we have been seeing is a fairly, at this point, friendly and iterative process with the states of working through the offering, and in some places, quite frankly, deferring to the SEC's review, even though those would be a qualification by full registration. Only 2 states in the union exempt Regulation A securities right now. That's Colorado and Louisiana. You don't have to do anything in those states. I personally think the GAO did a study on the effect of blue sky on Regulation A and other forms of non-exempt security offerings. It didn't really take a definitive position, but it did seem to indicate that it is extraordinarily burdensome on capital formation. I think the SEC and NASA understand that Regulation A and some of the other things coming out of the Jobs Act are going to be transformative to the capital markets, and NASA has filed a comment with the SEC saying that they are proactively working on a process to streamline state review under Regulation A and wants to work with the SEC on uniform standards. And I think, from the SEC's perspective, they have a interest in a coordination type regime, probably something like what we used to see in the days before NISMIA for public IPOs.
Thank you. I'm sorry, one more. Carl.
Given that part of Dodd-Frank and I guess the SEC rules not written yet, that's going to hold the broker-dealer community to a fiduciary standard in private placements, et cetera, and the fact that a Reg A, you're not going to have a safe harbor under Sarbanes-Oxley and or PCA audit, it seems to me that there's going to be a huge liability for any broker-dealer that would get involved in a Reg A offering, both from a regulatory standpoint, and the first time anything goes wrong, you're going to get sued. So just your comment.
Well, again, a Regulation A security is an exempt security, so it's not subject to Sarbanes-Oxley.
Right, but I'm talking about the broker-dealer having a safe harbor under Sarbanes-Oxley. As it is now, under a registered deal, if you're a fully reported company, a broker-dealer or a market maker has a safe harbor in relying on those certifications by the officers, where you're not going to do it.
Right, but you don't have Section 11 liability under Regulation A. There's only Section 12 liability under Regulation A. So that's how you avoid that issue. And then you combine that with Regulation A being exempt from SARBOX and the PCOAB requirements and what have you. The biggest issue for the broker-dealers, in my view right now, is FINRA takes the position, and I think they correctly take the position, given how they drafted their rules, that this is a public security and you need to comply with the public security requirements for syndications that FINRA puts out. So,
Anything on that? This is from the companies, and I'm sure, and the issue is, there's always a question here, is how much will it cost and how long will it take for Reg A? And the real question is it too early to start now?
Well, let me make a comment on that. We have kind of reviewed recent studies on taking companies public, and I think the averages run 1.5 to maybe 4 million, with maybe an average of 2.5 to 3 million under the traditional way of doing that. The Reg A's that we've seen being done by folks such as Rob and others are, I guess, maybe as much as maybe 80% below that, depending on a variety of factors. But suffice to say, they're substantially less expensive from a cost standpoint to get them out. They're much faster to do. And then for some of the issues related to the issues that Rob has raised in maintaining a Reg A company going forward, the regulatory cost and the accounting cost is substantially less. I think the other factor, well, let me leave it at that. Do you have further comments?
no, I think you're right. I mean, it is substantially less, and that's why I think this will be a critical component of capital formation going forward in this country when these regs come out. I think, from a legal perspective, on a $50 million raise under Reg A, I would estimate the legal fees, using a firm of my size as an example, probably $125,000 to $150,000 as compared to a minimum $500,000 under the 33 Act registration regime. From the accounting side, because we don't have a lot of the Sarbanes-Oxley rules around this, this has been one of the big proponents of the Regulation A reform, has quite frankly been the accounting industry, because the vast majority of accounting firms on a regional basis that have been sort of iced out of audit work because of the liability that comes along with 33 Act registration, it's been an unreasonable risk for them to get into that program. But now they see under Regulation A the ability to get back into audit work with regards to Regulation A offered securities, and you're going to have competition on pricing there. So I think it's going to be demonstrably less. I would also point out that, I've heard a number of people at various conferences and just phone calls I get who ask me, my understanding is that there's a freeze on Regulation A until these regulations come out. That is absolutely not the case. Not true. we commonly refer to the new regs or the new potential regs on Reg A as Regulation A plus, and existing Reg A as Reg A. Existing Reg A, you can do those offerings up to $5 million right now. And we have clients who are doing offerings at the $5 million level and less, quite frankly, with a viewpoint to using that as a stepping stone in a capital formation strategy. Do the $5 million now, develop your syndicates, develop your state of art on disclosure with the SEC, and then when new regulations come out, either amend or conduct a follow-on offering under Regulation A plus, supplement that information and move forward. So there's a lot of, and quite frankly, there's a lot of companies out there that look, $5 million is meaningful to them. And so from that perspective, you know, I think the broker-dealer community owes it to itself to look seriously at this method of offering. It's not going to be for everybody, but to look seriously at this method of offering, understand it, because I think there's huge potential down the road.
Michael?
Good question. So the guys at Satwick, Paul and Dinesh, have gotten me very interested in Reg A over the past 2 months, and we've spent a fair amount of time talking to the venture capital community, which has an issue and has had an issue for the past couple of years since that wave of, as I said, smaller IPOs in 2005, and since that really fell off after 2008, it basically went away. You've got the large and small VCs sitting with good companies that could not get public. So, aged companies in their portfolio. They'd like to see liquidity in these companies. They'd like to see trading. So that sort of has always sparked my interest. I think there's a time now, and the Satwick guys have been doing a great job at pushing on this portal, that getting these companies out, particularly if we can pass this $50 million threshold, but as Rob noted, $5 million, there are good companies that need $5 million. If you keep those expenses down, a $5 million Reg A IPO path to liquidity does make some sense. You got to keep the expenses tight, obviously, on that size deal. But the capital markets, as a lot of you guys know in this room, have been shut pretty effectively for the past couple of years, and I've seen a real fall off even in the past year. The amount of time it's taken to even get a small $3, $6, $10 million transaction done has stretched out. It used to be 30, 60 days. You'd find the buyers, small institutions or retail. The small institutions have effectively disappeared from the marketplace. A lot of the institutions that used to traffic in smaller companies have left. I'd say if there were a universe of 300 buyers, 300 institutional buyers that our firm would deal with for sub-$100 million market cap companies, that effective number today is probably 30, maybe 50. It's astonishing how much that's gone away. So I think that turns the onus a bit towards the retail firms, the independent firms, and we've worked closely with some of these larger independent firms, 1,000, 2,000, 3,000 brokers that are looking for product. And our role in that situation is to act as quarterback for the deal, find some cornerstone institutions, but really rely on retail, high net worth retail, to fill out the deal. I think it's an ideal place for good, solid, growing companies, profitable, revenue-generating companies to go public through Reg A, provide product for the retail brokers, for the independent brokers that I think really need the product, and I think that flywheel will start to go. I don't know if that answers your question. That's how we've started looking at it, and that's what I've started looking at, largely prompted, quite frankly, by these gentlemen. Yes, sir.
Thank you. Alan?
Knowing that the Reg A companies are not Sarbanes-Oxley compliant, what are the limitations on listing the company when exchanges are available?
So right now, it's anything that's a non-listed exchange, and I think that there have been some movements and some things talked about to create exchanges similar to what was in the, I don't know if you guys are familiar with the 144A market, which had a pretty exciting run a couple of years ago. I think it had about a 2-year run of raising a fair amount of money in the 144A sort of portal markets. There is the opportunity for Reg A companies to obviously trade on the pink sheets, trade on the bulletin boards, and I don't know what degree of familiarity there is with this audience with OTCQX. Our firm is one of the leading advisors to OTCQX companies. The OTCQX, in brief, was a vehicle by which foreign companies could trade their securities in the United States without dealing with Sarbanes-Oxley and the associated mishigas, for lack of a better term, that the regulators have put on the community in the past couple of years. So we currently advise 33 foreign companies. They trade on the OTCQX. We make a market in those stocks. We write research for those companies. There is the opportunity for Reg A traded companies to go on the QX. And what's needed is other broker-dealers, in addition to ourselves, to write research, make a market, expose those companies to the retail and institutional investor, and create liquidity. Because at the end of the day, the Reg A company that gets public, okay, there has to be something on the other side of that. You don't want to be, an orphan stock, 2 bid, offered at 5, never traded, doesn't help anybody out. Okay, doesn't help the brokers out, doesn't help the company out, doesn't help the investors out. So the mission's got to be on the other side. There has to be liquidity. So QX is an interesting vehicle, and I urge any of you folks that aren't familiar with OTCQX to go on their website because it's an interesting marketplace.
John?
Is there anything that you don't like about the proposed Reg A?
You're asking from a legal perspective or a market perspective? Oh, well, from my perspective,
Mike, please.
From my perspective, yeah, I don't like how long it's taking to get the regulations. But, beyond that, I think I'm generally, I have to take a wait and see attitude, see if the SEC throws us any curveballs in the regulations. The legislation, quite frankly, was pretty straightforward. I mean, it pretty much said, okay, we need to create another subsection of 3B, and SEC, you're going to increase the cap from 5 million to 50 million. You'll have the audited financial requirement, and you can make recommendations on additional reporting that may be required. We want to see Reg A's going on EDGAR. Right now, the Regulation A is the only SEC filing that is not filed through EDGAR or listed on EDGAR. So the way that you would get 2 filings if you hadn't been presented with an offering circular or whatnot is to literally do what my dad did in the old days, which is send a law clerk up to the records desk at SEC and get paper copies of this stuff. So that's all going to be on EDGAR now, which in my view creates enhanced transparency, and it's just ease of filing these things. Trust me, my associates, when they go get the 7 copies of all the exhibits and everything, are not happy right now. But beyond that, it's been fairly straightforward. I think what I don't like right now is there was not a time requirement. All kidding aside, they did not put a time requirement on this. They did not communicate a sense of urgency to the SEC. And then frankly, didn't provide any more definition around the ability of the SEC to create a lot of trading regulation around it. Now, I don't believe the SEC is going to do that tomorrow. I think the SEC is very much taking the position that they're under a deluge of regulatory reform right now. They don't understand. They really don't have a feel for the lower mid-market and mid-market in this country right now. I think they've been so attuned over the last 10 years to major IPOs and Wall Street issues that they really want to see this thing, feel this thing out with the business community on Main Street a little bit more before they would enact a whole lot of regulation around this. But I would have liked to have seen more of that. I also would have liked to have seen a potential for a legislatively mandated either coordinated review or NISMIA exemption. Right now, the law says that it will qualify as a NISMIA exempted security for purposes of state blue sky if it's listed on a national exchange, as we discussed. None of the 34 Act listed exchanges accept them, or if all of the investors are qualified purchasers Well, Congress conveniently left out a definition of qualified purchaser, so they've left that up to the SEC. So they could adopt the 40 Act definition, they could come up with an entirely new definition, and I wish the Congress had provided more concrete guidelines in that area.
Carl, you had a question?
One of the benefits of doing the reggae now is that at least you don't have people out selling unnecessary shells. I think also remember that technically, right now, if you did a Reg A offering, it's neither a 15B report.
The question is that a number of the Chinese companies on the QX, and I neglected that John's company, MERR, is listed on the QX. And the question is why so many Chinese companies had left the QX.
I think that there was a pretty difficult time with the Chinese companies doing reverse mergers here in the States and blowing up. So I think that we've never listed any, we've never advised any Chinese companies on the QX, and to my knowledge, mainland Chinese companies were not approved for QX listing. So Hong Kong traded companies were approved for QX. So the mainland Chinese companies that did the APOs and reverse IPOs and whatever else you want to call them was an extremely difficult time for 500 of those. There's a lot of fraud, et cetera, et cetera. So most of those companies, quite frankly, have just been delisted, period. But again, to my knowledge, none of those companies were on QX. At least we never advised any of them. The gentleman that was talking about, I think the point that you, sir, back there, Carl, I guess, that liquidity, that's the number one issue that faces this market today. So the question I think that we all have to ask ourselves as we look at Reg A is how do we create liquidity for these newly public companies? There are 2,100, 2,000, 3,000, whatever the number of companies that are orphaned public companies in the United States today. You just want to make sure that post this process, you're not creating another orphan. And obviously speaking on the behalf of the broker-dealers that are trying to provide market-making research and associated services, I think it'll be difficult for a company's self-underwriting to come out and attract sponsorship through research and market-making. That's going to be tough. The broker-dealer community, I think, is pretty much done with doing things for free. We've been working in the Peace Corps now for the 10 or 15 years, and I think enough people have gone out of business doing that I think we're about done. So I think that there's a need to, some of the stuff that we've talked about is the idea that market makers will actually be compensated for making a market.
All right, thank you.
Right? Yeah, what a novel idea, getting paid, right? It's amazing. So
Thank you, Keith.
So yeah. We'll see how that goes, but that would attract, obviously, more people to creating a liquid market. So we'll see if that happens.
Thank you. We're moving along here, and a lot to cover. And remember, in the expo room, I mean, a lot of times we sit in these meetings, then but we do have a follow-up type means right now with this Reg A site. So please, when you have a chance, the expo, to see Paul and John and Rob, and they'll give you how to get into the website and this new Reg A exchange. From the companies, they're sitting there and they're saying, okay, what determine how my company, or should I qualify for a Reg A offering, and what kind of criteria should a company be considering to qualify?
Well, Reg A is pretty wide open with respect to that. We've taken, I guess, an answer a little bit deeper than the question to look at what companies are going to be successful in handling both sides, the fundraising side and being able to take care of the market research. And we quickly kind of begin to zero in then on companies that have products, have revenues, have profit, or at least profit expected in the near future, and companies that are looking for an expansion round. Now, there are many companies that don't qualify to the criteria that I've just laid out, but that is kind of really becoming the sweet spot of people that we're talking about. We're not talking about, at least in our practice, funding startups. We're funding companies that range from $5 million in sales to, I guess, $114 million in annual sales with expected profits and good potential growth. And I think because the market making and the analytics need to be supported with fees that probably need to be footed by the company that is the issuer, all those things add up for us and suggest a company that is already live and well and moving forward.
Thank you. And we've got a lot of this about testing the waters. Can we clear that up again for once and for all of what is this? We've heard a lot of different interpretations of it. So a company testing the waters, what does this entail, Rob?
Testing the waters is a concept within Regulation A. It's permitted under Regulation A, and it's permitted in about 20 states in the union right now. The idea behind testing the waters is when a lot of times, I'm sure, when a number of you are dealing with clients who are thinking about putting an offering on the street, you may call some of your colleagues at other brokerages and get their feedback, and would this be something potentially that you guys would be interested in distributing? Testing the waters takes that to the next level and takes it beyond. The concept is that a potential issuer of a Regulation A security prior to filing could conduct a general public marketing campaign to gauge interest in that security. So company ABC is considering a Regulation A offering. They can, and this is contemplated by the regs, by the text of the regs, they could conduct a newspaper and radio campaign describing their contemplated offering and providing a within the newspaper ads or a phone number to call where you can indicate that, yes, I would have an interest in seeing that offering were you to put it on the street. That is the concept. It is designed to be very public, very broad-based marketing directly to the man on the street to gauge interest. Under a contemplated Regulation A offering, you could have your managing broker-dealer talk to other broker-dealers. That would not come under the testing the water regulations, but that kind of going direct to John Q. Public with a broad-based marketing campaign, that is under the regs. You do have to file those materials with the SEC. The SEC doesn't have a review and comment period for that. They just have those things on file so they can compare them against your offering information later to determine if there's any misleading practices going on. Those requirements for filing, interestingly enough, under the regs say that while it's not a condition to your exemption, these things are required. I don't know what that means. I don't think that's ever been litigated. But that, in a nutshell, is testing the waters.
Thank you. Marty?
Is there, since FINRA is so concerned about due diligence for broker-dealers, is there a due diligence requirement under the Reg A? Is there a third-party independent due diligence?
Well, all of the suitability and due diligence requirements under FINRA rules for public securities apply in the Regulation A context. So, yeah, I mean, the broker-dealer has to conduct its own due diligence. It has to know the customer. It has to conduct the suitability analysis, all of that stuff.
Yeah, but my question is most of these things, broker-dealers, especially the small broker-dealers, don't have the capability to do in-depth due diligence. So how does that get resolved, especially if you're advertising to the public?
Yeah.
And they may not make full disclosures, and then later on the deal blows up. So that's what FINRA is all up in arms about, and so the question is what happens to the broker-dealer if something blows apart and you haven't been able to meet with full due diligence requirements?
You want to fire first?
I think that tough call. I mean, I think the only thing you can say is that the firm really has to do the diligence, shouldn't take on the deal if they can't do the diligence. Maybe there's an issue with the geography or that makes it difficult or what have you. But I think there's such enhanced scrutiny from the investor side and the FINRA side, as you're pointing out. You have to be able to do the diligence. I mean, they'll, you know, as you guys know, FINRA's going through. They want to see their diligence files. They want to see all the you know, the path and and everything you've done to due diligence the company. So I don't think it's something that can be avoided. I think it's got to be just dealt with, and you got to have the resources.
Is that formed by the lead broker-dealer puts the deal together, or does every broker-dealer participating and have to create their own due diligence?
I mean, typically, the bulk of the due diligence is performed by the lead, and if there's a relationship that's a good relationship among the group, we can say, hey, you know, we've got this part covered, if you have that covered, but that's just trust, like everything else. You work with these guys before, and you know that they're going to do their job, and you're going to do your job. But typically, the lead BD is responsible.
Bart?
I was a little bit confused just a minute ago, Robert. You talked about newspaper advertising through the radio. Unless I've missed something, I thought that there was no solicitation available unless you pre-qualified those investors that they were accredited investors. So how can you have general solicitation in a newspaper to get meet that standard? Does that make sense, or am I misunderstanding?
Well, there are two different concepts under the Jobs Act, and the one that's gotten much more attention than Regulation A has been the concept of general solicitation under Rule 506 of Regulation D, which is the typical private offering exemption most of us in the room are used to operating under. What the rule says there is that you can generally solicit. However, all of your investors must be accredited investors. Now, the issue for the legal community in that regard has been, you know, well, what are the reasonable steps that can be taken to determine the accredited investor status? Because if you engage in this general solicitation under Regulation D, and you're wrong about one of your investors, you know, our concern is that the cow's now out of the barn, you engaged in public solicitation, and you're going to have federal and state regulators crawling all over your business. What the SEC has said in the proposed regs is, that's a good question. Why don't you give it a try, and we'll let you know if you did it right.
Talk to me later, right? Right.
Yeah. Now, but the distinction is Regulation A is not a transactional exemption. So Regulation A pre-Jobs Act and post-Jobs Act has said you go through the Regulation A process, you get qualified, you're exempt. The security itself is exempt. So there is no accredited investor requirement with Regulation A.
Bill?
Also, too, for any of us who have enough gray hairs to remember the 70s and the tax shelter business, the deal is called, if you're going to do the Reg D solicitations and you're an issuer, you better have a financial statement signed by the customer, because that's burdens falling on the issuer if they're not using the broker-dealer. The broker-dealers already typically will have all of the new account information forms,
Correct.
financial statements, and all the sign-offs.
Right.
And so all they're really going to do is hold everybody's feet to the fire to say, oh, well, I asked him if he's accredited, he checked the X. The X is gone, guys.
Yeah, that's true. Michael, in the back?
Going back before that question, we were talking about the general solicitation issue under Reg D. I know the rules aren't out yet, but isn't the discussions, and they haven't been finalized, but haven't the discussions with the regulators and their public appearances indicated that the general solicitation, you can just generally solicit across the board with radio, TV, or whatever, accredited, unaccredited, doesn't matter. What matters is when they come into your portal, when they come into your firm and your issuer, then you have a requirement to reasonably qualify them, which is yet to be defined as an accredited investor. So there's no pre-qualification for the general solicitation, there's a pre-qualification before you take money.
Yeah, that is absolutely correct.
Will you repeat
Right,
that?
but the issue from the lawyer's perspective is, yeah, but the cow's out of the barn once you've done all the general solicitation, so, you know, that reasonable inquiry is critical here. But you're absolutely right. I mean, there's no way to qualify anybody when they go and they pick up their newspaper or when they turn on their radio station.
Yes, way in the back, I'm sorry.
So if we want to start like a real estate fund, for example, right, and want to nationally advertise, would you recommend we go and want to raise $25 to $50 million? Would you recommend that we go Reg A and wait for the Jobs Act, or do we just go Reg D and wait for that one?
Well, you can't generally solicit under Reg D right now. Until those rules go into place, you can't do that. So, you know, you would be waiting, you would be conducting your private offering, you'd be waiting for that period to come out.
When you say we wait until they come out, which one would you suggest we use?
Well, I think it's obvious I'm a proponent of Regulation A because, you know, we don't have the issues around reasonable inquiry that you have under Regulation D, but you also have the liquidity, and this is critical. I mean, I think most of the people in the room will remember when you didn't have to conduct a $1 billion IPO. You could have a $25 million IPO, and there were regional investment banks, and there were syndicate members of all size. They've all been iced out of the Wall Street IPO business. This is, and the vast bulk of businesses that provide employment and are profitable in this country are lower mid-market and mid-market. So there's a huge opportunity here to create a viable trading market in these securities. And so I think that's, to me, that has a lot more attraction than simply general solicitation under Reg D. That is not to say that that is not the way to go for a particular business. It's a strategy and a decision that needs to be made by each business operator. But, you know, for me, I think as far as a long-term capital formation strategy and as part of a long-term capital market strategy for broker-dealers, putting the issuers to one side, I think the Regulation A has a lot of possibility there.
Well, I think certainly from the point of the broker-dealer side and for solicitation, and I think the costs, which was recognized to be substantially less, it might be something that you'd have to take a hard look at, but it's an individual decision from each of the issuers. Bill, you had a comment?
Yeah, I mean, I think the uptake that I get from this, and I just kind of want to see around the room, this looks like an opportunity to put us back in the game.
Thank you. I hope so.
And
Thank you.
the reality is that we talk about the issues that have been facing this country for a long time. Guys in this room, we can make all the difference in the world if we just decide to band together again and help each other get these things done.
Right.
Exactly.
Just like the comment you made earlier about, well, gee, what if we don't have the resources, you know, to do the deal ourselves? Well, this goes back to the old days when all the partnerships ran all of the Wall Street firms, and we all put our money up, you know, where our mouth was. We got deals done, and we made the world change.
Exactly.
We have that opportunity to do that once again right now. I think this is a really good bill for all of us.
Michael?
Could you, any of you, could you address the information that you'd like to see or might be required on defining your intentions on liquidity to the people in the Reg A, to the people that are going to be investing in the Reg A?
What's the liquidity?
As far as what is the plan, what are your thoughts,
Well, there's the
recommendations
market making, there's
on how that should be
specialization.
approached, particularly when it's not a reporting company?
Okay, you're talking about the actual trading liquidity? Is that your?
Yes.
An investor is going to say, you've got the presentation, you explain the fact that Reg A, when it's completed and closed, probably all three of you elaborate on the liquidity information that you would put in as far as timing and representations to the investors.
I'm going to let Rod speak to the legal part of it. My expectation would be that when you did a deal, that the company would immediately trade on the QX, for example. So you'd have to have. Your question is, what's the degree of liquidity? There will be a market made. You have to have an investment bank behind the market that's willing to make a market that has enough capital to make at least an effective market post-deal. I think the representations to the investors will be that there's a market made. There'll be research on the company, 30 days. And I don't know if there's a cooling off period with regard to Reg A, but assuming 30 days after the deal's done, I think that's critical to tell the story. And just there has to be an investment bank that's going to stand behind the deal, because if there's no liquidity and you're just creating another orphan stock, it's a waste of time. No one wants that. I think the other part that was addressed earlier by the comment about everybody getting together and working together is a larger syndicate or selling group of firms that are involved. That will also help shape the liquidity. The more of these firms that are involved, the better. Obviously, the larger deal, the better, because people can write a ticket, and obviously money is what's going to drive activity. So it might be tougher with the $5 million deals, but our expectation, obviously, is that we're going to move beyond the $5 million deals here, hopefully relatively soon. But trading liquidity is the heart of this. You raise a great point. I mean, that's the number one issue, I think.
Carl?
Yes, yeah.
Could you let him finish answering the question before you go to another?
Oh, I'm sorry.
All three of them.
I'm sorry, would you repeat the other two because we lost it a bit. The other two
Same
part.
question.
Okay.
He was going to let Rob address the legal.
Oh, the legal side, I'm sorry.
Yeah, let me maybe comment, we'll have Rob jump in. With regard to what we're doing, I mean, clearly Reg A allows a whole bunch of different things to kind of take place now, good and bad. And so what we've tried to do is working with the BD community, working with professionals such as John, Rob, accountants such as Deloitte Touche Price Waterhouse, we are wanting to have the industry really kind of raise an internal bar for the kind of companies that we want. John Rose made a couple good points. We want to get a lead underwriter that has the capability to provide ongoing market research. And importantly, the companies that we want to get involved in Reg A, the Reg A's that we get involved in, are going to commit to the cost of doing that on an ongoing basis, or we're not going to do business with them. So this has to be funded. It is, as Bill said, it's up to us, all of us, to kind of create the bar, the quality of what this affords us to be able to do. I mean, this is a tremendous potential for us, but it can be screwed up if we don't do it right.
So the question, though, was what information would you reveal or do you feel is needed into the investors for the liquidity to find what the intention is of offering a document for liquidity?
The marketplace would be defined. There would be examples of reports that would be given to the investors and to their broker-dealers to review, and examples of prior companies that had done similar filings. So that would be available, but the marketplace would be defined under the ones that we're working on. There's not a requirement to do that, however, but that's something that we are adding to it.
Okay. Well, let me give my response, and then you can fire off on the market side. Yeah, I think really, as it stands now, the market needs to develop here for Reg A. You're the guys that can answer a lot of these questions by what reporting standards you put in place. Now, the SEC will come out with some reporting standards for Regulation A. They're not going to be anything like reporting under the 34 Act. But, you know, a lot of that can be market-driven as well, and I'll let John speak to a lot of that. From the standpoint of your submission that there is not much more work with an S1 as a 1A, you're wrong. There is significantly more work with an S1 or an S11. The last time I conducted an S1, I charged the client $600,000. And with Reg A, I'm estimating for $50 million between $125,000 and $150,000. It's intended to be more streamlined. It's intended to be more market-driven. But I absolutely agree with you from the standpoint of the reporting, that's going to be driven by you guys. And that's the important point of getting the word out now.
And I agree with you about the elephant in the room. I think this is totally a liquidity-focused issue, and I think that's a good point. But to Rob's comment of the 150 grand versus $1 million, you know, there's a lot of dollars in there on the 1A versus the S1 that can be used to drive research and entice a lot of broker-dealers to be involved in the offering. So the more money that's available, the issuer can say, look, I'm not spending an extra $900,000 in legal fees. This is money that I can use to pay broker-dealers to help sponsor the security. We're not looking for, I mean, and I think that Paul and Dinesh have done a great job of highlighting this. We're looking for high-quality small companies, not low-quality small companies. The key is quality, good companies that need and deserve to go public and need capital. So it's critical on the front end that these are very high-quality companies. You guys are familiar with the UK, simply put, the corporate broker. is the firm that writes research, makes a market, gives the company corporate finance advice, capital markets related advice. The point is that the broker-dealer is paid every month for this service. That
Correct.
ranges anywhere from $10,000 to $20,000 a month, depending on the services delivered.
Okay, we could go on, and our timing is almost up, but when you leave conferences, you leave things, we forget, and the big thing is a follow-up. And we now have a means here with this Rig A exchange. If this is something that makes sense, we're looking for means to getting back to work, creating jobs and things that we do as broker-dealers, and for issuing companies to get you the capital that need to it. So please go into the resource area and then get the further information, but hopefully we're going to be able to continue to follow up as events happen over the next 2, 3, 4, 5, or 6 months. It looks like a viable way, get my brokers back to work, hopefully for the issuing companies, maybe another alternative of raising some capital. I mean, the time is now. I mean, we need to get back to work. We're down to, about 1,500 brokers now doing, alternative investments, and we're losing those. 1,200 of us, fines or another. So we need to get over that. We'll pay the fines, but we need to start getting some revenues, and revenues is what drives all of us. We're all small businessmen, and most of them in this room. I mean, working together. Remember the old team thing. Together, everyone accomplishes more. And I want to thank the panel. I think it's a superb job. This is a tough subject. Thank you, gentlemen. Thank you. Okay, with that, we're going to do our presenters parade, which is coming up, and so we can get a face with the companies. And Judy, would you like to please come up? Thank you, panel, again.